Good morning, this is Charlie giving you Monday's market commentary. Hope you're very well. Now, I've had an email come in from a trader called Keith, who's actually asked me a few weeks ago when we had some free people in the people who came in for 2-3 days in our live trading room. He was asking about the S&P and what triggers can we look out for to detect the start of an S&P crash, so to speak. So that was his question. So, and I forgot to answer it last week, so I said, I'll tell you what, I'll cover it off in the video update. And so, and then he continued to tell me about an £8,000 loss he took on an oil buy last week without stop loss. So another reason why we always say it, use stop losses, because obviously you can lose a lot if you don't use stops. But anyway. Coming back to his question, what should we look for? Because what he was saying was, what's he say on his email here? You know, the world economy is slowing, etc., etc. So should we be looking out for that? So this is a good point. And so if I just delete that off screen. So what could we be looking at the moment structurally? If we actually go out to maybe if I can take us out to a weekly chart, we can see that the market has made new highs. So structurally, you can argue that, well, we're making new highs in the markets here, and so all the time markets are making new highs, then we're still in a bull market. Absolutely. When we had the lows come down here, I mean, I think a lot of us were surprised that we did come up and make new highs as quickly as we did, but we have done just that. So, but having said that, yes, there is the potential always that if the world economy does start to slow over the next 6 months, then we see these markets roll over again a little bit. So normally I look for sort of divergences here, and I'll do my price comparisons. So I'll just put up these. So if I, oops, what have I done? That's actually just putting them in off screen at the moment. 27. So the first thing I look at is the percentage of stocks that are trading above their 200-day moving averages, which you can see is this line here. So on the daily charts, we can see as the markets have broken to new highs, we can see that the percentage of stocks trading above their respective 200-day moving averages haven't actually broken to new highs, because if we look over here, the line here, which is showing us those stocks as the actual S&P 500 index has broken to new highs, we can see that the depth of the market, the market internals, so to speak, the actual number of stocks that are participating in that is fewer, because the line's lower over here where we are today and to where it was previously. And if I zoom out a little bit, we might even see a little bit more. We can see that the percentage of stocks trading above their respective 200 moving averages is actually, with each successive new high, we can see it's actually making successive new lows. So that's a potential problem. But I think what we need to see is some price action on the dailies. I'll turn this off now. Let's actually get rid of that. Some price action on the dailies to sort of tell us that maybe this is going to roll over. Sometimes you get something like a key reversal day or something like that, but we're not seeing that, and it doesn't look like that sort of thing is going to happen because the way this is rounded off the way it is. So it may be something which starts off slow and then maybe builds pace and momentum over a period. But at the moment, I cannot give you a definitive prediction that this market is about to roll over and fall over. It's had a tremendous run. So any pullback that we have right now, we have to assume is just a pullback until proven otherwise. We've got divergences there, like I've said, but it's not that easy excuse me, to try and catch an absolute top there in that market. Could it be? Of course it could be, like always. There's always the possibility that this is the market's final hurrah, so to speak, when we look at that weekly chart with the new highs, but then, like I just showed you, the stocks participating are lower. And I can look at some other breadth measures as well. But certainly, for now, structurally, we have made new highs in these markets. So until proven otherwise, we are still in this bull market. And what would prove otherwise is a break below these lows, but that's a long way off, isn't it? So I think first and foremost, if you wanted to start looking at this as a potential bearish move, you've got to at least wait and see if price breaks below, gets below the daily 21 moving average, my blue line here. So at least that's given us an intermediate term, short-term intermediate, that actually price is breaking and going below that, and that's turning over and rolling over as well. So I think that would be the easiest measure. Trying to catch it up here would be very difficult because we do not know at this stage if we are indeed about to roll over. So that's the only thing. Very vague, I'm sorry, but there are some divergences there, admittedly, but the price action is at new all-time highs, but we have got some divergences. I would want a little bit more confirmation at the moment. We've got a sharply upwards facing 21-day moving average coming up to meet price at some point, and then it's really only once if price was to get below there and it then starts rolling over, then I could then start having a look at it. But to try and call a top right here is a tough one. Having said that, I'll probably look back at this in 6 months' time and say, oh yeah, there was the top there. Right. Okay, so that's 6 minutes in, and I think I've just covered that one off. I think the only other thing that I'll mention then is coming back to trading. Please use stop losses. Kim and I talk to people all the time about this sort of thing, and yet we still hear people doing that sort of thing. You won't be successful over the long term if you trade like that. So I shall leave that with you for today. It's a fairly short one, and be back on Friday for live trading.